Well, I'll kick it off a little bit for everybody and just do a quick introduction to while we have folks streaming in. First of all, welcome. We're starting to ramp up a little bit of our angel programming here at Switch. For those of you who don't know, I know some of you are familiar with Switch. Those of you who aren't familiar with Switch, we have actually been around since 2006. And we were formerly Women 2.0. We rebranded a couple of years ago, but have not lost sight of our mission, which is a very heavy focus on gender and representation in the tech startup space. We do a lot of programming for founders, in particular, women founders and underrepresented founders.
Oh, Kate, we lost your voice from we can't hear you now. Your headphones, I think.
I thought it was me.
Yep.
I was like, no.
Sorry.
There you go.
So we have a heavy focus on founders, largely in the startup space, high growth startup space, pretty good focus on the tech, but not exclusively. And we deal with sort of early stage, so pre-seed all the way through Series A. We work a lot with them on growth, fundraising, and leadership development. In addition to that, in the past several years, we have done a lot more work on the capital side. Our philosophy is essentially that we can spend all the time we want with these great, amazing founders, but if we're also not making as many impacts as we can on the investment side, we're really not going to get where we need to go. So a lot of that has involved participation in the VC space and also very heavy participation in the angel investing space. For us, again, sort of a philosophical standpoint is that the more women that we can get into positions of check writing power, first of all, the more influence they'll have on the space. And check writing power, and we'll go through this in a second, can be angel investing, it can be an LP, into a fund, it can be a lot of different types of things. And then additionally, research suggests also that that money will tend to flow to a more diverse set of founders. That's kind of what Switch is all about. Flag for folks. Here too, we do have an angel investing group, and we are just about, as part of that group, we're also just about to launch our 7th cohort of our angel investing course, which is an 8-session. We run it once a week. That'll start on October 3rd. In depth, we have amazing VCs who are teaching each course. And I know we've got a couple people who've gone through the course here. It's an excellent opportunity to jump in, to learn about some of these different aspects of angel investing in more detail, things like due diligence and legal and what the heck is valuation, how do we come up with them, and all that sort of good stuff. So please do let us know. We'll drop a link to take a look at that, and we'll also follow up via email. We have a question from Marina. We'll bring you right up if you want to. Marina, did you have your hand raised?
No, actually, Bootstrap now ready with timeline to launch by end of the year, beginning of next year, and now want to raise angels round. Just
okay,
starting to get connected.
Great, welcome. You're welcome to join us. I'm glad you're here. We will focus the topic for today on sort of the process of being an angel, but of course, feel free to chat and listen. It's also probably pretty helpful information for any founder to know as well. So welcome.
Yes, of course. Thank you so much.
Yep. Okay, wonderful. Without further ado, I am going to ask our panelists to introduce them. These are wonderful friends and colleagues of mine. And I'm excited to have them here today. I'm going to let them both, I think people do a better job of introing themselves than I'll ever do. So I'm going to let Katie first introduce herself.
Okay, well, thank you, Kate. So excited to be with you guys. I just have to say, I think these two are some of the most powerful, most supportive, bestest friends I could ever have in this crazy world. So I really, it's really fun to be with both of you guys. So my name is Katie Dunn. I'm an angel investor and advisor to startups. I invest in underrepresented founders in CPG and tech. I've invested in over 25 companies now. And then as an advisor, I have a company called Power to Pitch with my business partner, Kat Weaver, where we help early stage founders with their fundraising strategy, including grants, as well as raising capital. So I can vouch for this angel investing class that Switch put on because I was in the first cohort many years ago now. And I met Kate on a whim through Chief and saw her post about this angel investing class. And she was offering a little bit of a discount at the time. And I was so excited. It was exactly what I was looking for. I had made a couple investments. It was height of COVID, so I didn't have anywhere to go. I could make the time to take this class, and it was honestly the best investment. I have now invested alongside it with Kate in more than a couple deals. It allowed me to expand my angel investor network. It taught me so much. It gave me so much confidence to go in and actually do this. So I'm really so grateful to Kate for this whole journey.
Thank you. And I promise that
You did not tell me to say
I did
that.
not plant all of these things. I appreciate you, Katie. Can you also just a little bit about your current focus in angel investing, some of your activities? I know we'll have plenty of opportunity to talk about it, but just sort of, I know you've got some industry focus, et cetera.
Yep. So I invest in consumer packaged goods, including a bunch of beverages. Part of my thesis is that I don't invest in direct competitors, so that I have a spirits brand. I'm not investing in other spirits brands. I invested in a wine brand. I'm not investing in other wine companies. I have some wellness. I have some B2B SaaS platforms and kind of tech light, as I like to say it. I am not a deep tech investor or an AI investor yet. I think every company is going to be an AI company. That's just my theory anyway. So, and my thesis is to invest in underrepresented founders, which to me means people of color, women, LGBTQ. That is not exclusive. I have made exceptions for certain people and for certain companies because it's really, to me, about the founder and about if I think I can be helpful to the founder in pushing their business forward. And so I also do very early stage pre-seed and seed, and I like to do follow-on rounds, meaning I'll invest in after the pre-seed, I'll invest in the seed round and the Series A if I really like the company and the founder.
Great. And those are a couple things we can come back to because as I say to every single angel investor, you do you in this process. Great things to hear what other people are doing. There are a lot of options in this space. Alex, you're hitting this from a little bit of some similarities, a little bit different aspect, but tell us about your background and why you're here.
Yeah. Actually, well, thank you, Kate, for having me. And I love to do anything with you and Katie. I'm always inspired by both of you. So doing this is the highlight of my month. So yeah, a little bit about my background. I come from an operator background. I've focused my whole career pretty much in operations and finance. I've done everything from retail manufacturing. I've always been around the supply chain and logistics side of a business. And then I went on to work for a marketing agency where I got to see CPG from a different angle. And most of them were large brands like PepsiCo and Gatorade and so on. So that was really an interesting opportunity because I didn't get to see it from the building side, but for how to build a brand. And then I went on to work for tech startups in between. And that's how I ended up building your cohort after so many years of working in different industries. I really just wanted to be able to support founders as they're building their businesses from a very early stage, because I'm a huge believer that your financials and how you think through your business, if you want to call it back office, is going to really, it is a component that does impact your success or your scalability or your ability to fundraise. So that's a little bit about my background as far as investing goes. I've done more investments on manufacturing. I've done more investments along with my family. We've done funds, and we've done a lot of different types of manufacturing businesses. Again, we come from a supply chain background, so I know that topic very well. And I actually, if you want to call it, I'm a nerd about it. I do love all that comes with that. So that's really where we've focused on. I have not, like Katie says, I have not done tech as of yet, but now that I am more and more in tech, given the nature of my business, it's definitely giving me an insight of how to look at it if that's the next route that I wanted to take.
Great. Thank you both. And just very quickly, I'm Kate. I'm CEO of Switch. I'm also a general partner at the W Fund, which is a VC fund. We invest into early stage, primarily women and underrepresented led tech startups. I do angel investments a lot in tech. I have done some non-tech. I have done a Broadway play, which I'm still waiting on from a success standpoint, but you know, another story. And again, like Katie, primarily my angel investments are into women and underrepresented founders. I have certainly made some exceptions for some just amazing, wonderful humans as well. And that's a good little segue. The first thing I wanted to chat about before we do some good Q&As. And firstly, please feel free to pop questions into the Q&A section. The first thing I wanted to just position everybody on is that an angel investor, first of all, there are some accreditation hurdles or qualifications given by the SEC that designate whether or not you're essentially allowed to invest into this asset class. Beyond that, what you do as an angel investor, it's not necessarily into tech, right? It is that you are writing out a direct check from your own personal set of assets and capital into a thing. We here primarily do sort of higher growth startups, but there's real estate. Again, there's a Broadway play, that type of thing. I do also want to flag, especially for our panelists as we go along, we did get one question about a place for micro investors. So that is actually a really fantastic segue into this kind of maybe larger budget pool of angel investing are things like equity crowdfunding. We have a lot of people who will start out doing equity crowdfunding, very similar process, sort of the same due diligence aspect, different legal structure, different minimums, and a different level under the SEC, but really fantastic. And Laura, will be a lot of what we're talking about, I think, will also feed that question about a place for micro investors as well. Wonderful. So now that we're sort of level set on that, generally speaking, again, angels sort of play alongside, VC firms, real estate investment firms. Katie also has a background in real estate as well. So you're kind of playing along some of these larger established investment arms in various different capacities. So the first question I wanted to ask the panelists is, it's a little bit broad, so answer however you'd like. But essentially this idea of like sort of who could, anything, what should we be thinking about when we're getting into angel investing? What are some of the characteristics, the skill sets, maybe the personality types that you think about both for yourself and everyone here is very well networked in the angel space. Those set of things that somebody might need or not need, because that's important too, when they're thinking about becoming an angel.
Katie, you want to start?
Sure. So there's a lot of things that you need. I think I could, speaking for myself, I came from a background in finance, and so I was really comfortable with numbers, doing due diligence, talking in millions and billions instead of hundreds and thousands. So my comfortability, is that a word, with talking about money was established long ago, because that's, as Kate said, I was a commercial real estate lender. And you have to really be comfortable with talking about money and asking the questions that you may not know the answers to, or you think are dumb questions. You got to be able to ask them. So I think that was one thing. I think the network is the other really, really big thing. And I worked really hard on developing my network, because that's how you see good deals. The only way that you get deals or you share deals is through your network. It's really hard to find good deals if you don't have other people to talk about things with, especially because as an angel investor, you're usually operating on your own and you don't have a team like a VC firm does. So I think those are two big things. And the third thing I would say is having a level of risk that you are comfortable with, because like Kate said, the reason why you have to be an accredited investor is because startups are really, really, really risky. And there's a good chance you're going to lose all your money. And I already know I've lost a lot of money on some early bets that I made. And I've learned lessons from them, but I had to be willing to lose that in order to make those checks. So understanding what your risk level is, this is not investment advice in any way, shape, or form, but having a diversified portfolio is really helpful, both within your angel investment portfolio and your greater financial portfolio, so that you're not locked into all your money is in one thing.
Yeah, I think that one thing I add to that is also leaning to the things that you know. Like I said, I've really focused a lot when it's come to investments in manufacturing, because supply chain is my strength. And also I enjoy it because you're going to have to read about it, understand where it's going, what's the technology that is evolving from it. I think reading is a huge thing about angel investment, that sometimes people don't realize that you need to do a lot of reading to understand really about industry trends, who's leading it, who are the top investors in it, why, what are the risks happening. I think really educating yourself constantly is a never ending part of being an angel investor, as well as thinking through what are your strengths, as far as if you have to analyze a business, what is your strength? Is it the marketing side? Is it the finance side? Is it the people side? And then lean on your strengths, but then also have maybe a group of people that you can share those businesses that you're looking into that have other strengths that you don't, or find a way to compensate for those. So if finance is not your strength, then how do you learn more about it, or lean on someone to help you look at a business that way? I definitely think also leaning on angel investors that have been doing it for a long time. I know that that's how one of the best ways that I've learned is really learning from people who have been doing this over and over and over and over, because you can't find that wisdom, honestly, in books or anything. That's really more about personal journeys and stories. So I think it's really important that you also grow your network.
Yeah, that's such a good point. I just want to bring up, I followed so many angel investors, and I'll invest because they invest. Kate's one of them. And then Annie Evans and Kelly Arena that have Dream Ventures and Golden Hour Ventures. There are two others that, if they bring me a deal, I look hard at it because I trust them, and I think that they've got a great network. I think they've got the pulse. I know how they do due diligence. And that's the beauty of angel investing. You can lean on these people. It's not like a test that you have to take on your own. You should be leaning on each other for research and advice.
Yeah. And I'm going to take a little, here's the thing about this asset class. We're talking about risk. We're talking about, my God, there's a deep level of knowledge, etc. One of the things I do like to talk about, and there was a question too about what do we do if we don't have the finance background, or gain knowledge of vetting deals or any number of these things, right? The legal standpoint, all these aspects of it this is what, just as Katie and Alex just said, this is what communities help with, angel groups. I know literally just informal groups of friends who invest together. There are a plethora of resources online to be learning, whether it's a formal course like ours, whether it's some online, free training or articles or reading and that sort of thing. And one of the I've heard so many angels who have said to themselves, I wrote that first check and then I was good, right? And so understanding that there is a big hurdle sometimes to be getting in and feeling comfortable with it, and there's nothing wrong with that at all. Also understanding that part of it is also getting going. We're going to talk a little bit about things like budgeting and how you can do that in a smart way, using things like frameworks and things like an investment thesis, right, to help guide you on that. But some of it is also, you don't particularly have to come from a particular industry in order to get into it. It's more about what part of the process do you love and want to get into? Is that going to be fulfilling enough for you? Do you feel like you've covered your bases from a risk standpoint? All that good stuff. So sort of on the flip side too, is there's this, what do we do to get over that hurdle a little bit too? Great. We have a couple of questions. And maybe we'll save some of those. They're good questions. Well, I'll ask this one because it's fitting right now. I would like to use my knowledge, strengths, and experience. However, how realistic is it to improve your knowledge in other fields without only leaning on others? So I would probably say this is probably depending on the topic area that you're talking about. So something like legal, I'll be totally honest, as an experienced investor, legal is one of those things I tend to really lean on people with legal advice, because a lot of times that's a make or break. A lot of times there are things that will come out in future rounds. And I frankly don't know that I can even fill that gap completely to not ever have anybody to lean on. So that's an example of kind of choose your poison. Whereas way in the, something like how do we assess founders or what's the go-to-market strategy? I'm very comfortable in those areas. I can frankly probably lean on myself. And so I think it's about who you'd have to lean on, where your gaps are, and also just being realistic about those gaps. Just as you would go into a company and be CEO, your role is not to be an expert in every single thing, right? Your role is to figure out where you're best suited, where your time and energy is going to be best placed, and then where you need to fill in the gaps. That's a little bit how I think about it as an angel investor. Katie or Alex, do you have anything on that?
Go ahead, Alex.
Yeah, I think another way, and I tell you this from not just investing, but the nature of what I'm doing, that I'm constantly seeing new businesses and seeing new things. The way that I've learned to honestly acquire new knowledge on a new industry, maybe I have an interest, right? And I want to learn about it. I've really maybe picked one or two brands, or I pick and someone who's an expert. For instance, I've learned a lot from accounting firms. Bookkeepers have a lot of knowledge. Tax people have a lot of knowledge from the business of how the business should be set up or how the business needs to be thought out. And the reason why is because each industry has its own uniqueness. For instance, healthcare, the billing system to healthcare is very unique to healthcare. You won't find the way that billing happens in healthcare in other industries. So to me, they've become incredible resources that I lean on, that I've become very close to get me insights into the healthcare. Same thing with alcohol and the beverage industry. Very unique way of running that industry that no other industry functions the same way. So again, leaning on the accounting teams, the tax accountants, to me has been essential because it really tells me how the groundwork has to be set up. So when I look at a deal, I look at a company, or I look at a deck or anybody coming, I can right away, if they don't have that foundational structure, I already know that they're gonna have to fix it. And that's an issue, because that means that the founder doesn't quite understand the foundation on how the business has to be built from the ground up. So to me, learning about other industries, aside from expert, like people who invest in those industries, has been leaning on accountants and tax accountants.
Great. Carmen has a great question, which is right where we were going to go with the conversation. So I'm going to actually just use her question. Great to hear about the risks experienced as an angel investor. What are the upsides? So we're talking, what type of financial returns are you seeing? What's the timeline that we should expect into some of these things? What is your experience with incremental financial returns over the life of the investment versus like windfall at exit? So let's get into some of that, sort of how these deals are structured. I might just start out positioning folks a little less familiar with this space, is that typically angels, unless you're what's sort of called a super angel, which is large check writers, you know, $250,000, $500,000 into a deal, you're usually sitting in the early stages of a deal. In high growth startup terminology, it's pre-seed, seed, sometimes Series A. But you're right in that place where the risk of failure is very increased, but your opportunity to get more equity is also increased. So then what essentially happens is that startup moves on, gets further investment rounds down the way, and then your investment goes through a period as a privately held company where there are no returns, and you're getting a payout. Usually there are a couple ways you can get returns in there, but we don't need to complicate that right now. It's and then you're waiting for an exit, which is most often an acquisition. So we hear about all the IPOs, but that's actually not the most common way that you're making money. Acquisition, merger, you know, anything sort of within that realm. Again, there are other asset classes. Broadway plays have, just for anybody who's interested, have like a couple of sort of yearly cash out returns. Then there are different spots. So there are actually like various levels of payouts as you go along. It's just structured differently. Real estate has a whole different one. So first thing is look at the return profile, number one. So then let's chat about things like timeline, any upsides you see on this, like how much, where's our money going? What is it doing during this process? That sort of thing.
So I have lost more money than I've made at this point, just to be totally honest. It's and I think it's important to be honest about this stuff. I did a lot of I've sort of started investing about 6 years ago now, really seriously. I did a movie years ago, which I did not get returns on. But so I'm starting to see the failures, and it's the companies that, you know, the founders have all but given up, or they haven't necessarily closed the companies, but it's a matter of time before they're going to. I'm also in the process of my first sale. So that exit, I think I just did the math the other day. It's going to be about a 40% year-over-year return on that investment. So I'm pretty excited about that. There's other companies I hope that they sell for, sorry, the little dog there is, I don't know if you can hear that, trying to make a nest. There are other companies that I hope will sell, that'll give me a 5 times return of my money. There's others that I hope will give me 10 or 100 times the return of my money. It just depends. It depends a little bit on the industry, the type of business, when they're going to sell, how much growth there is, that kind of thing. So it is a long game. You have to be patient capital, and there have been times where I've said to my founder, you need to be starting to talk about an exit. You need to be talking to people in the industry that you could exit to, and find out if what kind of metrics do they want to see in order to be, and for us to be an acquisition target. So sometimes you have to have that conversation because founders get in just growth mode, and you can see them burning out. I have seen that time and time again. And I want them to understand, like, this is not, you did not want to do this forever. Remember, you wanted this to be a business that you sell. So what are the things that are going to take you to get there?
Yeah, I definitely think whatever you're investing, this is not money that you should be missing in the next 10 months or 12 months or, you know, even 4 years, 5 years, because depending, like Katie said, to the industry, some will take a little bit longer, right? So if this should be money that you're okay waiting for to come back, and wait, and it should also be money that I think, and Kate, jump in here, I think it's also money that you have to think about when you're investing, what that cap table is looking like. I have seen scenarios where the cap table has like 40 people and there's checks from $500 to, you know, decent sized checks. So what does that mean when there's so many people in the cap table? Are you really going to be able, like, is that going to be convenient for you to put that money in there? So even if you're investing early, look at that cap table and try to understand where you fall as an investor and where does your money fall when you're looking at that. I think that's the other one that is it's a big one.
Yeah. Yeah, and I think to add a little structure to this. So some of the things, and these are all really good questions to be asking when you're thinking about your budget, which we'll talk about next. When you are assessing a deal, what is that payout structure? What is the timeline? So for example, in high growth tech startups, your general timeline, if you were to invest in seed stage, you're looking at 3, well, really sort of 4 to 6 years before you might see an exit. Sometimes it's longer, sometimes it's sooner, but like get that kind of in your head, right? So your capital is illiquid until that point. Other really important thing to think about is portfolio diversification, right? You got one shot at goal. If you miss it, you miss it. Got 20 shots on goal. You could stand to lose, miss a couple. So that then translates into things like, what's your budget? How many investments are you going to make? That type of thing. There have been people, the way that VC funds work, for instance, is some VC funds this is when they call them unicorn chasers. They're literally looking for 2 or 3 of their 20 companies to be successful. And the expectation is they're making up for all the other 17 or 18 companies. So that's how, I'm not suggesting you do that, but that's kind of when we think about, when Katie says that she is starting now to see her exits, part of that is based on time. She used the word patient capital. That's kind of one of those things to be talking about. And so those are some really important things to ask, some really important things, if you get a chance with the founder, sort of what are you thinking in terms of an exit, that'll help inform you, like, what is happening with my money here, type of thing. Let's go into budget, because I think it's a really important piece of this. I'd love to hear from both of you how you think about your budget. I'll just start off by saying, first of all, this is a you do you. I know some people who will have a half an hour conversation and there's there's like a check going out the door. They just sort of do it when they have conversations. They're not necessarily a plan. Great for them. I always suggest to people thinking about getting into angel investment is to think about roughly a 12-month period. It can be, you can do whatever you want. 12 months is like a great sort of, average way to think about it. If you were to think about 12 months, how much money would you want to divert to this pool of investments. And just for conversation's sake, the industry standard, so to speak, is sort of once you've done your retirement and your mutual funds and sort of this hunk of less risky investments, many people are putting up to about 15% of their assets into this asset class, if they're investing into the asset class, right? Not everybody does, of course. So that it's a good benchmark. You don't have to. Then you look at that budget and you say, okay, great. If I have 12 months, I want to try to do 8 deals. I'm being hypothetical here, right? That'll give you a sense of like, okay, I'm looking for deals maybe around like 5K, maybe less, maybe I can do a little bit more. Maybe you can sort of start doing some mapping in there. That's just like a general process. But Katie and Alex, I would love to hear about how you've thought about this idea of like, okay, I'm accredited now, technically speaking, but then the actual, like, I'm writing out checks. Talk to me about that for a little bit.
I actually have a funny story on this. I actually, one of
Please
the,
bring
not
it.
that long ago, I actually did, I'm telling you, not even, I think it was about 12 months ago or something. There was a tech company that I really, really loved. And I was ready to write my check and I was so excited. And then to find out that they had a minimum that I wasn't willing to meet, right? And so I got turned down because I wasn't meeting their minimum. So sometimes, it's like shopping, if you want to say. It's like you have your budget and you are looking to split it in a certain way and a certain structure, and there might come the chance where a company has set a minimum of those checks, and you end up not being able to participate, which in my opinion made me think, okay, is my budget not the right structure, or do I, maybe the type of companies that I want to do, I'm going to have to do bigger checks. So which means that I'm going to have to do less companies. So that scenario was really interesting because that had not happened to me. It does happen when you think about funds, but it had not happened to me from a company perspective. So that's a little bit of how I think thinking about what kind of companies and what are their minimums based on again, what's the industry or the type of founders. A lot of second time founders, I find that have a little more structure around that because they've had a first lesson go around. But that's been my lesson with budgeting. It's not just what I can do, but also what's happening in the market based on minimums.
I think that's a really good point. That's actually, so the first question I ask of founders when I get a cold outreach for a deal is, or any outreach for a deal is, do they meet my thesis? The second is, what's the minimum check size? Because the last thing I want to do is get like so excited about this company, really want to do it, and then feel like not be able to write the check. Because I don't like to write checks, initial checks, and it was higher when I first started, above 10,000. And I like to have them, and I've invested $500 in companies. I have over $100,000 in another company. So it just depends. It's totally a wide range. But I've done WeFunder rounds of $500, $1,000, $10,000. I did a crowd lending deal, which I put $1,000 into. But just knowing what your tolerance is, if something doesn't completely meet my thesis, I'll do a smaller round. There are certain things like you can participate in syndicates, which is a great way to write smaller checks and not have your line on the cap table as a part of a group rather than your own name. But that's a great way to throw a little bit of money in something that you like. But I think one of the biggest myths out there is you have to write $50,000 checks every time. And I cannot tell you how many angels I have met that did that to start out with. Their first check was 50 grand, which mine was not, for the record. There's the big one that I've invested in is I've invested over time. But the biggest regret is that they did one $50,000 check rather than 5 $10,000 checks, or $25,000 checks, or whatever the math is there. I just did the math wrong, whatever. Anyway, The point is, don't be afraid to start smaller to get that diversification built up. And then as you do the follow-on rounds if you want to, or start writing larger checks as you get more comfortable. But that's the biggest thing. Like, I think people think, I got to have all this money to do this, and it's going to be all wrapped up into this one thing. It doesn't have to be that way.
No. And there are more and more opportunities to come in at lower check size. Like for our group, we generally we'll do a 5K minimum check, which is low. We've done them as low as 2,500. It ends up being a hard fundraise for the founder on that. So it's sort of like you got to figure out this happy medium. But our big thing, and there are many other places that do this now, they're really increasing, is that we want to be able to be accessible to newer investors, right? And so again, there are a number of opportunities. That is a question that is a really great initial question when you're assessing or thinking about a deal. Where can I go to get lower check size opportunities? Or if you have a deal in front of you, what is that minimum check size? Katie just mentioned what's called a syndicate. That is, syndicates invest through what's called a special purpose vehicle, an SPV. All that is literally like a pop-up LLC that pools all the capital. It's led by somebody or firm. There's a syndicate lead, and you're investing into one of that pool that then they're the ones who get the equity. That equity sort of gets passed through to you. Excellent. There are some economics involved in it. As Katie said, excellent way to get some good deals under your plate for like a much lower, and there are syndicates all over the place.
Yeah.
So really great opportunities to kind of like, and Katie's big point, I just can't reiterate enough, which is just like, you don't have to be writing out enormous, nor should you be writing out enormous checks. It's actually disadvantageous to you. So starting to kind of hopefully make it feel a little bit more comfortable when you're thinking about this budget area. And then to that very first question asked, and we've brought up a couple times here, there are then things like equity crowdfunding, et cetera, where you can do a $500 check and that type of thing. Obviously your exposure is smaller, but doesn't matter. You're getting you're getting yourself in there, you're dipping your toes in to your comfort level. And that's a really great pathway in as well. So
and Kate, can I add one thing to that? I think also the budget is what you are able to manage, right? If you're going to write 15 checks, that means you have to manage 15 investments. And you want to be on top of them, and some of them will need help, and they're going to send you material, and some of them will have certain level of commitment that you have to put in or not, right? But whatever the amount that it's of companies that you're looking to invest, is also because you're willing to manage that workload that comes with that. So I definitely think through that. How much are you willing to do the due diligence before, and then maintaining that relationship with the founder after you've invested. So I think that is something that you should take into accountability when building your budget. What is your time bandwidth?
Perfect segue to the next question, which is, how do we also think about our time when we're doing this? And time can include assessing a deal. Time can include post-deal relationship with founder. The first thing that I'll say to folks is that there is a very wide spectrum on this. This is definitely an area where there's no right or wrong. I mentioned that I know someone who does deals after a half an hour phone call, boom, check written out, and then they're kind of moving on. That's pretty darn quick. I know some people, I've got this wonderful friend, she's a lawyer, she is a researcher. She does about one deal a quarter because she wants to take a lot of time on the deal. That is her comfort level. So part of this is understanding what you want to get out of an investment, what you feel comfortable with. And I like to tell people, like, what is the when you get to the point of, I've got enough information where I can say yes or no, Like, what do you need to get to that point? And then what relationship do you want to have? So can both of you just quickly talk about how you think about time? And again, I'll sort of synthesize at the end, pulling out some of the ways to think about it. But
So I think that's a really good point. There's a lot of different ways you can support a founder, and some of it's money, some of it's your time, your spending time with them, being a customer, sharing it with friends, being an advisor, helping them fundraise, make intros. There's so many other things that you can offer. And a lot of times that's more impactful than just the cash to a founder. I have one company that I've invested in. I know I'm the smallest check on the cap table, but they say I'm the most helpful of any investor they have. So there's also things like some of the syndicates I've done with Kate, for example, because Kate is the lead on those deals. I know and trust her and know she's all over it. So I don't have as much interaction with the founder or stress about the day-to-day because I know I can ping Kate and be like, what's going on with that deal? So that's part of it. And then there's others that I at times have had weekly calls with the founder to help move things along or to make intros or whatever it might be. So it just depends. And it also depends on my bandwidth, my expertise. I try and do things that I really, that's another part of my thesis. I want to be in a deal where I think I can be helpful. I don't have to be a customer. I don't have to, be a user of the product. In fact, I'm not a user of a lot of the things I've invested in, but I have to see the value of it and see how I can make intros for them in other ways or help them in other ways.
Yeah. I think the time aspect, especially when you're starting out, I think you should give yourself enough time to get through the motion of the process and figure out what is going to be your standard of when you're looking at a deal. So I think really the first time around, giving yourself time to not put yourself pressure, like, oh, I have to invest or I have to do this or I have to do that by then. No, like, and by the way, founders will put a lot of pressure, like, oh, we're closing around tomorrow. Like, okay, and then it wasn't meant to be, right? If they're closing around tomorrow, it wasn't meant to be. But I think taking yourself the time to build out your discipline and how you're going to structure looking at a deal, and then what do you want to do? Like Katie said, like, what are you doing? Are you doing introductions? What is the value add? Because giving the money is just part one, but now they have to grow. Now they have to find a go-to-market feed. Now they need to find a team, right? They have to build a team. So just writing the check and not being able to provide a little more to that founder, it's gonna make it harder for them to go into the next round. So as an investor, you want to make sure you're helping them, pushing them to get quicker to that next round, because that's your investment. That's how you're setting up yourself for more success. So I think the first time around, just give yourself plenty of time, because there's going to be a lot of nuances and there's people involved. So personalities get in the middle too. So learning how to manage that relationship, investor to founder, is also a very important one.
Yeah. I'll sort of like tie this together, and you've heard a couple times sort of the word thesis, or sort of setting some frameworks up. Creating an investment thesis is a really great place to start for this. And first of all, investment theses change and are living and will be reassessed and refined as you go the process. But sitting down and thinking about things like, how much time do I have? How much budget do I have? What stage do I want to invest in? What industries do I want to invest in? Is there a mission that I want to try to accomplish? And that could be anything. It could be, I am extremely focused on climate. It could be, I want marketers in their jobs to have a better job, right? So really, and we actually run these workshops to sit down and do this, but that is an excellent set of sort of like preliminary ways that you can slice and dice some of this and really say, okay, this track, I know I'm great at, I'm an expert here. But I know I need a little bit more time here, or I really want to advise also with my check. I don't just want to write out a check, right? Really sort of thinking through what you want out of that investment and putting it into a nice framework is a great place to start guiding folks, and yourself.
The other thing, Kate, sorry to interrupt, but the best thing the best use of my thesis is how I say no to founders, because I get pinged. I probably get 10 a day on LinkedIn and through my website of people that want me to invest in them. And they don't fit my 99% of them, 99.9% of them don't fit my thesis, but they don't take the time to figure out that they don't fit my thesis. So I can go back to them and say, it's not you, it's me. You don't fit my thesis. And I don't have to dig in and say, your traction isn't good enough, or I don't believe in you as a founder, for example, which happens sometimes. So I just don't even get there with them, but it gives me a reason to be able to say no, because you have to be able to say no. You cannot say yes to everybody. You have to be strict about it. And one of the biggest things I see founders struggle with is they don't get real feedback. That's something I pride myself on. I give real feedback. If I'm not going to invest in somebody, I tell them exactly why. And if they don't like it, they don't like it, but at least they got an answer. So they can go back and work on it. Or maybe I've taught them that investors have theses and you've got to go find what it is so you don't get a no from all these people.
I also
Awesome.
think your thesis.
Yeah.
Oh, sorry. Go ahead.
No, go ahead. Go ahead.
No, I also think theses help in two other ways. One, it keeps, once you start getting into this and you start building a network of angels or however you're getting your leads, you're going to start getting tons of different deals. And so you can get lost in this labyrinth of just looking at deals, and you end up not even investing in any because you've spent months and months or weeks and weeks just looking at deals, because now you're in that ecosystem, and once people find out that you're doing this, you will get, like Katie says, she gets about 10. So if you don't have a thesis, you get lost in this pool of deals. And then the second part that I actually think it's a good one with the thesis, it also helps you think through, okay, how do I, if I'm investing in this one thesis, how do I diversify my network? Because the other thing is, and I've seen this a lot, is that you end up just talking to your friends who do this. And so you don't go outside your friends. Try to find people, connect with people that you might not be connecting with on a day-to-day basis, because they might be getting, even though it's the same industry, they might be getting different deals. And remember, all these early stage startups, it's all word of mouth. Yes, there are some places where you can find them in LinkedIn. And of course, there's like syndicates, but a lot of it is word of mouth. And so it's all between the circle, the 5 people, 6 people of connections that they have. So helping founders be able to, for others to see what they're doing, diversify yourself in that thesis, make sure that you're connecting with outside people in that thesis. It helps you build your network, and really helps also the ecosystem have a more diverse group of investors.
Yeah. I'm going to do a lightning round of responses quickly. Belinda asked good places to look for and evaluate syndicates to join. Really quickly, the 3 biggest pools are: number 1, most angel groups are doing all of their investments through a syndicate SPV structure. So that's number 1. There are a bunch of networks like AngelList, et cetera, that have a load of people who are running syndicates through there. Now, the thing with that is that you have to do a little bit more due diligence on those syndicates if you don't know them. There are varying levels of due diligence. You want to sort of look at their activity. You got to dig in a little bit more. And then, as we just talked about here, is networking and asking around. You'll start to get invited into deals, or you can ask, hey, how are you doing deals, and that sort of thing. So those 3, I would say, are good places.
The other one,
Yeah.
I want to just give a shout out to our friend Cheryl Kelland, Play
Yes.
Money. The website is Play Money. She's running syndicates,
Thank you.
and I
Yes.
absolutely love her platform. And she requires a lead to vouch for the deal. She's trying to get more women investors, or more women investing, I should say. So you can follow the people whose deals you like.
Yep. Awesome. Liz, hi Liz Wagner. Okay, this is a very quick one, but might be on some people's minds. Setting up a separate company for your investments, doing it from personal accounts or setting up an LLC. So yes, there are tax implications around that. First of all, this is a question best suited for your financial advisor. I always suggest at the beginning, barring that you're not investing out of a trust, that's sort of a separate issue here. I say get started, usually doing it from a personal account and just understanding the process a little bit. And of course, combining that with information from your financial advisor. But usually that's like I'd hate for somebody to go set up an LLC, write out one 5K check, and then all of a sudden they're like, I'm never doing this again. So it's like, get into the game a little bit. It's not going to have too much impact on your taxes to get started. Then if you're sort of like, yep, I'm in, figure out the best structure. So I still invest primarily out of my personal account, and then we do investments through Switch. There are a couple of other questions here. They're very specific, and we've got 1 minute. We did not get through about half of these questions. We could talk for ages here. I want to ask each of you for parting words for our angels here. I am also happy to stick around for a couple more minutes if somebody does want to stay. But I'd love to hear parting words for each of you for folks, and it can be anything under the sun for folks thinking about angel investing.
You want to go first, Katie?
No, you go first.
No pressure.
I know we didn't get to touch on it, but it's something that to me has been incredible, and I think everybody should consider it at one point if you're looking into angel investing, is that it's not only that there's a company side, but there's also the fund side. And I think educate yourself to what is angel investing as a whole, because it might not be that you're into the company side, maybe you're more into the fund side. So my parting words are really do your due diligence, talk to a lot of people, take Kate's course. Kate is really she's a phenomenal teacher, and she really understands both sides. And when I say both sides, the fund and the individual investment, and just, educate yourself like you would with anything else before you go out and start deploying capital.
I just would echo, I can't say enough good things about Kate's class. It's a great overview. You get access to the angel group. If you're even remotely curious, it's very affordable. The investment I made in that was worth 10 times that amount. So I would really, really encourage you to do that. It is so fun too. It is so fun. I mean, supporting these founders, sharing their wins, seeing helping them with a challenge and giving them support is really, really rewarding. I love it so much. So everybody go do it. Give money to other women so they can give more money to other women, and we can all just be super rich and have so much fun.
And I will end. Thank you both, firstly, for coming. I appreciate it always, and I love talking to both of you. I will end with my normal power speech and remind each of you that in every check you start to write out, you have a ton of power in that position. And that ownership of that power has the potential to make such an impact on the space in so many ways. It allows you to have direct input into the future you want to build. It allows you to support founders you believe in. It allows you to build generational wealth. It allows you to use your hard-earned capital in ways that suit you. And I really want to offer to everybody to think about that when you're thinking about this journey, is that upside and your entry into the industry is just a really phenomenal, phenomenal thing. So I'll end there, and I can stick around. Everybody can leave. Panelists, you are welcome to leave if anybody wants to stay. Thank you again.